Welcome to PIMCO Pod. In this episode, we discuss how U.S. tariffs are mostly hitting businesses, with smaller effects on consumers so far. Stay tuned after the conclusion of the podcast for additional important information. The Economic Impact of U.S. Tariffs: Waiting, Watching, and Planning by Tiffany Wilding. Since January, the Trump administration has imposed broad tariffs, both across the board and targeted, with more likely to follow. At the same time, Congress, with the administration's encouragement, has passed legislation to reduce business and household income taxes. When and how the U.S. economy adjusts to this new regime is still an open question. Current conventional wisdom is that domestic households ultimately will pay a good portion of the tariffs as businesses charge higher prices to offset the higher cost of imports. In turn, higher prices that reduce disposable incomes are expected to reduce real consumption and weigh on near-term economic activity. Over time, greater incentives to invest domestically could provide an offset. However, after 3 months of higher tariffs, data suggests that businesses' pass-through of higher tariffs via higher prices has been slow and uneven. Corporate profits appear to be absorbing more of the additional costs, at least so far. While businesses could still adjust prices and labor costs, which could weigh on aggregate incomes, the post-pandemic surge in corporate margins and the front-loaded tax incentives in the One Big Beautiful Bill Act, OBBB, may prompt more gradual adjustments. The upshot is that the near-term impact of this year's policy changes, slower growth, higher inflation, could be milder than expected, making it easier for the Federal Reserve to resume its shift toward neutral monetary policy. The downside is that lower corporate profits could lead to tighter financial conditions before the new tax and tariff regime incentives foster the capital expenditures needed for the economy to shift away from its reliance on consumption. History provides a guide. The scale and scope of the Trump administration's tariff policies are unprecedented in modern times. These policies have already raised the average effective tariff rate that the U.S. currently charges on imports to roughly 11%, from less than 3% in 2024, based on Treasury data. In the second half of the year, we expect that number to increase further when additional sectoral and possibly higher reciprocal tariffs are implemented. The closest analog for an industrial economy is the Smoot-Hawley Tariff Act of 1930, designed to protect American farmers and manufacturers from foreign competition. It boosted the effective U.S. tariff rate from less than 10% to about 20%. Amid these dramatic changes, we, like many forecasters, have made educated guesses on the near-term economic effects based on historical studies of industrialized economies that experienced smaller policy changes. A common theme from these studies is that absent a large offsetting currency adjustment, businesses tend to pass on a good portion of price increases to households, and consumer prices adjust, reducing real disposable incomes. This finding has shaped the current conventional wisdom on how the U.S. economy is likely to behave. Signals in recent U.S. economic data. While history provides a potential guide, we also have several months of data to signal how the U.S. economy is actually adjusting to this year's tariff policies. Based on observations from various official data sources, we conclude that consumer pass-through has been slower and more uneven across industries. Overall, companies appear to be paying the bulk of the higher tariff-related taxes so far, although there is some evidence of attempts to maintain profits through lower import prices and lower labor cost growth. Consider the following economic data. Treasury import excise tax collections and census-reported duties. Treasury's daily cash statement reports significant tariff revenue collections, despite media reports of business strategies to evade tariffs. June collections were on pace for about $350 billion annualized. Data from the U.S. Census Bureau, which calculates duties based on detailed tariff schedules applied to product and country-level imports, appears consistent with large actual collections. Both data sets suggest the average effective tariff rate on all U.S. imports is roughly 11% as of June. Consumer Price Index. In June, companies began more aggressively passing on the cost of tariffs through consumer goods price hikes. However, the change in goods price inflation from the beginning of the year suggests only about 20% of the total potential price pass-through has happened. Core goods price inflation has accelerated by 1 percentage point, PPT, since January, despite a fall in auto prices. Treasury corporate income tax payments. Treasury's daily cash statement reported that June corporate income tax payments fell below $70 billion annualized. That amount is similar to 20% of the roughly $300 billion in annualized tariff revenue the Treasury collected for the second quarter, nearly matching the expected decline if firms absorbed most additional tariff costs. Employment Situation Report. June U.S. labor market data showed a contraction in aggregate hours and real incomes, while travel industry data suggests that companies are also cutting back on business travel to reduce costs. Import Price Index. While Japan has reported lower prices of auto exports to the U.S. and U.S. reported Chinese import deflation has recently accelerated, broader U.S. import prices have contracted about 1% year-over-year since the beginning of 2025, nowhere near enough to offset the 11% average effective tariff rate increase. Furthermore, the roughly 6% depreciation in the U.S. dollar year-to-date should make foreign imports more expensive in U.S. dollar terms. Forecasting the tariff impact. Insights from current data. What is the outlook for this to continue? Comparing additional tariffs against domestic aggregated profits reported in the National Income and Product Accounts, NIPA, suggests that tariffs could result in a large one-time hit to corporate profits if fully absorbed. According to NIPA, the estimated $350 billion in annualized tariff revenue equates to around 11% of after-tax profits, or 9% of pre-tax profits. However, the post-pandemic surge in margins argues for some room for businesses to absorb near-term costs. A full absorption would lower economy-wide corporate margins by around 2 percentage points, back to pre-pandemic levels, according to NIPA data. The One Big Beautiful Bill Act's inclusion of retroactive business income tax cuts should offset some tariff-related costs for the aggregate business sector in 2025, and could also enable businesses to continue to adjust more slowly to tariff policy. That said, the companies most affected by tariffs probably aren't the companies that stand to benefit most from the OBBB. Legal questions further complicate the tariff outlook, and this means larger businesses able to weather the near-term corporate margin hit could continue a gradual pace of tariff-related adjustments. In May, the U.S. Court of International Trade, CIT, found that President Donald Trump's use of the 1977 International Emergency Economic Powers Act, IEEPA, to implement sweeping tariffs exceeded the law's authority. The Supreme Court could rule on the case later this year. Should the Supreme Court uphold the CIT's decision, the Treasury might need to refund all collected tariff revenue. The Trump administration could pursue alternative tariff measures under Section 301 and 232 investigations, which are more resilient to legal challenge, but require additional time. For the Fed, evidence of slower pass-through that may mitigate peak inflation has to be good news, even if somewhat higher goods inflation is more persistent beyond this year. U.S. households could be relatively better off if the higher burden of tariffs compounds gradually over time. However, there's also a risk that near-term corporate profit weakness to surprise investors and tighten financial conditions before longer-term investments can be made. Thank you for listening. That was the economic impact of U.S. tariffs, waiting, watching, and planning. For future insights, please follow us on your favorite podcast platform. Macro Signposts highlights weekly takeaways from the data analysis conducted by our team of economists and other macro experts. For PIMCO's official views on the global economy, please visit PIMCO.com. The discussion and content provided within this podcast is intended for informational purposes only and may not be appropriate for all investors. Reliance upon information provided in a podcast is at the sole responsibility of the listener. The information included herein is not based on any particularized financial situation or need, and it is not intended to be and should not be construed as a forecast, research, investment advice, or a recommendation for any specific PIMCO or other security, strategy, product, or service. Past performance is not a guarantee of future results. All investments contain risk and may lose value. Investors should speak to their financial advisors regarding the investment mix that may be right for them based on their financial situation and investment objective. Podcast may involve discussions with non-PIMCO personnel, and such content contain the current opinions of the speaker, but not necessarily those of PIMCO. Other podcasts may consist of audio recording of an existing PIMCO article, and such material contains the current opinions of the manager. The opinions expressed in all podcasts are subject to change without notice. Information contained herein has been obtained from sources believed to be reliable but not guaranteed. PIMCO, as a general matter, provides services to qualified institutions, financial intermediaries, and institutional investors. This is not an offer to any person in any jurisdiction where unlawful or unauthorized. For additional important information, go to www.pimco.com/gbl/en/general/legal-pages/podcast-disclosures.